the Bank of England has just cut interest rates for the first time in a while, and it's dropped them from 4.75% to 4.5%. Now, this might sound like just another financial headline, but the impact of this decision will be felt by everyone. It's going to impact businesses and investors, to students, job seekers, and anyone with a mortgage or a savings account. So how does this actually affect you? And what should you be doing right now to stay ahead of the game? That's what we're going to discuss today. So first and foremost, why did the Bank of England cut rates? Two main reasons. The UK economy is struggling. So the Bank of England originally predicted 1.5% growth in 2025. However, it's kind of cut that in half to 0.75%, given there's a clear signal that things aren't going as planned. Second issue is inflation is still a problem. So at the same time, inflation, how much prices are rising by, is still a big problem. The Bank of England expects inflation to increase to 3.7% later this year before it eventually cools off. Now, by cutting interest rates, the Bank of England is essentially trying to do a few things. First of which is boost spending and investment. So cheaper borrowing, when interest rates drop, it means cheaper borrowing, right? Cheaper borrowing means businesses and people take out loans and spend more, which helps the economy grow. When you're spending more, prices tend to go up, right? Businesses tend to earn more money and the economy grows. Lower debt costs. So mortgage payments, credit card interests and business loans become cheaper. So when interest rates drop, all these types of payments, debt costs tend to go down. Supporting the job market. So when businesses can borrow easily, they hire more people and expand operations. If they've got more money to spend, they're going to spend that on hiring more people in some sectors. However, there is a risk if inflation doesn't fall as expected. Cutting rates too aggressively could make things worse by driving prices up even further. So that's something to keep in mind. All right, how does this impact you? Rate cuts aren't just something that affects big banks and investors. They can have a direct impact on your personal finances. If you've got a mortgage or a loan, for example, it's good news because it means lower interest rates, reduced borrowing costs, meaning your mortgage repayments, if you're not on a fixed rate or loan interest is going to go down. But beware, if you're on a fixed rate mortgage, you won't see an immediate benefit right away. If you have savings, it's bad news because the banks are going to pay you less interest on your savings when rates fall, so your money earns less over time. However, what you can do is consider moving your savings into higher yield investments, such as individual savings accounts, index funds, or dividend stocks. Okay. The impact on job hunting. So this isn't something most people think about, but when interest rates drop, it does impact job seekers. If you're hunting for jobs right now, sectors that benefit from rate cuts include finance, real estate, and tech, as they might be hiring more given that they have more disposable income to spend on this type of expense or hiring. However, economic uncertainty does remain. So the Bank of England predicts that the employment rate will rise to 4.8% next year, so competition could still be tough. If you invest in stocks, it's good news because it means lower interest rates typically push stock prices or stock markets higher. More on that below. Okay. Why did the FTSE? So when interest rates drop, the stock markets tend to rally. They tend to increase in value, or stocks tend to increase in prices. Why does that happen? So the FTSE 100 surged to an all-time high after the Bank of England's announcement. But why? Here's the simple explanation. Lower interest rates make bonds less attractive. So there's stocks and there's bonds. And when interest rates drop, the yield, so the return on bonds, tend to drop as well, making them less attractive. As a result, people start putting their money into stocks. Investors shift, so investors move their money into stocks instead. And as a result, this pushes up the stocks prices even further. Companies benefit. Companies benefit from cheaper borrowing, which can boost their profits and stock valuations. For example, imagine you're an investor. If government bonds are only paying 2%, but stocks are returning 8% plus, you're likely going to put your money into stocks, right? So this shift from bonds to stocks is exactly why the FTSE 100 stock market jumped after the rate cut. Takeaway: if you're an investor, pay attention to interest rate trends. Rate cuts often fuel stock market rallies. Okay, so what's next? More rate cuts. So markets expect at least 2 more rate cuts this year, and there's a 55% chance of a third. But the Bank of England has made it clear that they're taking a cautious approach. Why? Because inflation is still unpredictable. 2024, even now, the Bank of England expects inflation to peak at 3.7% before dropping. 2026, the anticipation or expectation is inflation is going to drop to 2.5%. And then by 2027, in an ideal scenario, they want an inflation target of around 2% is expected to be reached. All of that is kind of, what would be an ideal situation, but time will tell if that actually happens. If that prediction is wrong, the Bank of England might have to change course and slow down the rate of interest rate cuts. So the big question is, will rate cuts be enough to fix the economy, or is more action needed? The global wildcard, so Trump's trade tariffs, quite a tongue twister that. Another factor that could shake things up is what's happening in the US. So Donald Trump is hinting, or has hinted at imposing tariffs on the EU, Canada and Mexico, possibly not the UK. This, we have to wait to see how it plays out. But how does this affect the UK economy? Essentially, there's a big potential benefit and there's a big potential risk. The potential benefit is that if the UK avoids tariffs, it could become a more attractive trade partner. And the potential risk is, if global trade slows down, it could still hurt UK businesses. The Bank of England hasn't factored Trump's trade policies into their forecasts yet, because they simply don't know what's going to happen or what the guy is going to do. Actionable steps. So what should you do next given these rate cuts? If you have a mortgage, consider refinancing if rates drop even further. So that way you can benefit from lower repayments, interest rate repayments. If you have savings, look for better investment options like ISAs or stocks. And if you're investing, follow the interest rate trends. Rate cuts often mean stronger stock markets. So keep an eye out on particular companies that you want to invest in. Typically when rate cuts happen, stock markets rally. Last but not least, if you are job seeking, if you're hunting for a job, keep an eye on industries like finance, real estate and tech, because these tend to hire when rate cuts tend to happen. The big takeaway, stay ahead of the game. So the direct impact is interest rate cuts might seem like a boring financial headline, but they directly impact your savings, investments, job prospects, and even the prices you pay at the supermarket. Knowledge is power. Understanding these shifts gives you an edge, whether it's knowing when to refinance, where to invest, or how to navigate the job market or in a changing economy. Future outlook. So with more rate cuts potentially on the horizon, this is just the beginning. The ripple effect of interest rate cuts. So when interest rate cuts happen, how does that impact the rest of the economy? What happens? Typically, interest rate cuts set off a chain reaction in the economy. As borrowing becomes cheaper, both businesses and consumers tend to spend more money. This increased spending can lead to economic growth and job creation, which are both good. However, it's a delicate balance, as too much spending can lead to prices increasing too quick, so lots of inflation, which is why the Bank of England has to carefully monitor the situation between interest rates and inflation. Okay. Global context, so the UK's position in the world economy. The UK's economic decisions don't exist in a vacuum. So what the UK does, it has ripple effects all over the world, right? The Bank of England's interest rate cuts must be considered within the broader context of the EEA, the European Economic Area, global economic trends and geopolitical factors. Understanding this wider perspective helps in grasping why certain economic decisions are made and how they might affect the UK in the long term. Economic policies affect everyone, and public opinion can influence future decisions. Whether you're a financial expert or just starting to learn about economics, your perspective on these rate cuts and their impact is actually very valuable. Engaging in discussions about economic policies helps create a more informed and participative society. So try and stay informed. Watch these videos if you're new around here. Read up on these topics and subjects, because they impact everyone. The more we are all informed, the more informed decisions and choices we can have to better ourselves and the economy and the greater society. What do you think? Are these rate cuts enough to fix the UK economy, or is more action needed? Drop your thoughts in the comments below, and I'd love to read some of them and maybe reply to some of them as well. Hope you enjoyed this video. If you made it to the end, give it a thumbs up. The slides that I used in this presentation will be available in the video description, and I will see you in the next one. Peace.